Hi, I'm Iain Pyle, manager of the Shires Income Trust. The trust is a income trust which invests primarily in UK equities, as well as preference shares and some select overseas equities. And it has a goal of delivering really resilient, high levels of income, but also maintaining potential for capital growth over the longer term. So current positioning of the fund, the structure remains the same as it ever does. So the main differentiator of the trust compared to other UK equity income products is really that positioning in preference shares. So about 25% of the assets in high yielding preference shares, currently yielding over 8%, with the attraction that they will be very stable and that income will be very resilient over the long term. If we look at the equity portion of the trust, then positioning really reflects what we're trying to achieve, and that is defensive, resilient income plus capital growth. So the sectors where we see most potential for that at the moment are financials, insurance, banks, utilities and energy, really sectors which have good cash characteristics at the moment, and importantly should be quite defensive as we go through any more difficult period for the economy. The areas where we're relatively underweight would be those that are more consumer facing, consumer discretionary, consumer staples, and they're also sectors where we see less attractive income characteristics due to thinner margins and simply lower payouts from those companies over time. So changes to the fund's positioning, I don't think there have been material changes. The big change we will see coming up in the not too distant future will be the merger of the trust with the Aberdeen Smaller Companies Income Trust. And that will have the effect of taking out our position in that trust, but adding in more direct investments in small and mid-cap companies in the UK. It won't change the positioning a huge amount because we've always been quite size agnostic and we've got a pretty meaningful weight in small and mid-cap companies already. But it'll just give us a little bit more flexibility and discretion about how we invest in that part of the market. And that is a bit of the market which has really underperformed in the last year or so, as we've seen a bit of a liquidity withdrawal in the UK market. Mid-cap companies have performed more weakly, and that's really opened up some interesting opportunities from our point of view to get good quality, growing small mid-cap companies in a bit of the market where, if you look long term, has historically outperformed the large cap very strongly. So that will be a change that's still to come. In terms of what we're doing in positioning today, I think we're generally looking for things which have really good defensive characteristics and really resilient income. That won't be a surprise, but I think at the moment we see market levels as reasonably high. I would be fairly nervous about the direction of the economy into next year. And I think getting those things that can be really resilient and have a good structural underpin for long-term growth, particularly at utilities at the moment, is a good way to go. So recent performance has been quite good. If we look at the quarter up to the end of September, so the third quarter of 2023, then the fund outperformed the benchmark by almost 1%. And if you look at performance over the last few years, what has been a headwind for Shires relative to a pure equity benchmark has been that exposure to preference shares. Because they trade like bonds, when we see interest rates go up and bond yields go up, naturally they underperform equities. And in the last couple of months, we've started to see interest rates get towards the top of the cycle, we believe. We've started to see bond yields reach a level. And in that environment, the preference shares, which have this wonderful 8% plus yield, have started to come into their own a little bit, and the headwind has been removed. So they've been a good performer. That's helped the whole trust perform pretty well over that period. And as we look forwards, our hope would be actually interest rates are not going to go down quickly, bond yields are not going to go down quickly, but just that removal of headwind means the preference shares will hopefully continue to perform well. They won't be a drag. They'll deliver that income that we believe shareholders want, and that would be very helpful to performance. The rest of the equity portfolio, I think we've seen the more cyclical, smaller UK end of the market perform poorly through this period. And as I've mentioned, there's been a bit of a liquidity withdrawal in the UK, which has harmed those parts of the market. What's done well has been exposure to energy, where we've seen energy stocks perform well in that period. And also, we're starting to see some bits of strength in things like real estate, which have been really weak into this period, but where actually as bond yields start to peak, the valuations look pretty attractive, and there's a bit of a rally there as well. So, two relatively recent purchases in the portfolio. The first is the most recent thing we've added, which is a company called Assura, and it brings together a lot of the things I've been talking about in terms of defensive ability, but also combined with long-term growth potential. And Assura is a real estate company, but it's a real estate business that owns properties specifically serving the healthcare sector. So things like GP surgeries and buildings like that. And what that gives you is a portfolio of property assets which is very defensive. You know, those tenants are very secure, they're well protected, they're generally government funded, and pricing has been a strong grower over time. You've got some good pricing power within that sector. And that means Assura as a company has a very stable growing NAV. It also has delivered over time a really stable growing dividend yield. And at the moment, it's around a 7% dividend yield, so quite attractive from our point of view, roughly double what the benchmark provides. It also, because of that really unique characteristic of the property exposure, should be very defensive, and that is nice for the next couple of years. Where it tends to have suffered is when bond yields go up, the shares get discounted more, and the shares have been weak in recent years. As we see bond yields start to peak out, it's a great opportunity to buy back into something which is a good quality income compounder over time. So that's a recent purchase. And the other one I'll talk to is Lloyds Bank, which is kind of the other end of the scale, big UK domestic bank. And it's one where we talk about looking for defensive exposure, but the market's perception of the large cap banks is that these are not defensive, and if you have a recession, they will perform poorly. But actually the characteristics of Lloyds would make it much more resilient in our view. It's got a very strong capital position. The majority of its lending is in UK mortgages, where risk of default is very low. And due to changes in accounting, it's already well provided for in terms of losses in the event of a recession. So actually, we think it'll be pretty resilient. It's seeing a bit of pressure at the moment as interest rates rise and customers shift money from current accounts with low interest rates into time deposits with much higher interest rates. That has a bit of a drag on profitability. But despite that, this is a business which is still trading on around a 6 times PE, so a meaningful discount to the market. It is paying a good dividend, and it's also buying back a lot of its shares. And buybacks are something that have really come into focus for the UK market in the last couple of years as companies look for a little bit more flexibility in their capital return framework post the pandemic. And companies look at their share prices in what's an undervalued UK market and see an opportunity to reduce the share count and do that in quite an efficient way compared to paying out dividends. Lloyds is positioned to pay back a lot of its share capital in the next few years. So if we look out over the next 3 years, actually it has the potential to pay over 40% of its market cap back to shareholders. And even if you believe that sector is quite cyclical, that gives you a very big margin for error over that investment time horizon and a high level of income. So one that is interesting for us and where we think the market is maybe a little bit too negative. So outlook from here going forwards, I think it's a bit of a contradiction in that I'm quite nervous about the macro and about the economy. You can see signs of consumer strain, and you're eventually starting to see the impact of higher interest rates come through into the real economy as people's mortgages go up and people use their cash to pay down borrowing. What I think makes the outlook better is that actually a lot of that is in the price for UK equities. And UK equities continue to trade at a record discount to other developed markets, while companies are still performing pretty well, particularly in the less cyclical areas of the market. And payout ratios are low, balance sheets are in good shape. So I think we can have a pretty high level of confidence in terms of delivering income and delivering long-term growth. And I think we've got a portfolio which is really well set up for any short-term headwinds. So I want to be cautious, but definitely cautiously optimistic. Thank you very much for taking the time to listen. If you would like to find out more about Shires Income, please do visit our website or click the link in the description. Thank you.